Cracker Barrel has gotten a lot of attention recently, but is this stock a buy right now? Welcome to the Food Fund. Will hyper-emotional outrage turn this company around? Let's dive right into it. Let's start with a price action. Over the last year, you're looking at a good 34% CAGR. Zoom out to 5 years, and it's a minus 15% CAGR. The company has had a nice price bump until recently. Over the long term, the stock has performed poorly. Market share is a key factor for food and restaurant companies. The dashboard shows Cracker Barrel is the fourth smallest casual restaurant company, but it does not seem to be growing quickly. Looking closer, they have a 0.43% share of the market among public food, beverage, and restaurant stocks. Over the last 5 years, Cracker Barrel's market share has actually grown at a 3% CAGR. They've gone from 0.39% in 2021 to 0.43% today. Slowly and steadily, the company is improving. Let's look at the fundamentals for more. Gross margin is 33%. This is pretty good for a legacy restaurant company. Revenue has grown at a steady 6% CAGR over the past 5 years, now at $3.5 billion. Though the rate of growth has slowed, revenue is still growing. However, cash flow looks way more bleak. Operating cash flow decreased at a 12% CAGR. CapEx worsened at a 24% CAGR. The result? Free cash flow has fallen at a 45% CAGR. Despite the growing revenue, operating expenses and increasing CapEx has obliterated free cash flow. This is not good. Weighted average shares outstanding have decreased over time, going from 23.8 million shares in 2021 to 22.4 million shares most recently. Cracker Barrel has done a good job of buying back shares and reducing share count. Longtime shareholders are happy with this. Next, return on invested capital. This tells us how efficiently management has used capital from investors. Going from 13.3% in 2021 to 3.8% most recently, Cracker Barrel has gotten less and less efficient over the years. This is very bad for the company. For operational efficiency, measured by the cash conversion cycle, Cracker Barrel also doing poorly. It went from 11 days to 19 days. Management has clearly dropped the ball and the company is worsening. Finally, debt. Net debt to EBITDA has risen from 2.4 in 2021 to 12.9 most recently. Despite falling from the peak of 19.1 in 2024, Cracker Barrel is doing a horrible job managing their debt. Now, let's compare Cracker Barrel's performance against the gold standard, the S&P 500. Investing $10,000 in Cracker Barrel would have shrunk the investment to $7,491, compared to $36,399 in the S&P 500. That's an annualized return of minus 3% for Cracker Barrel versus 14.4% for the S&P 500. Cracker Barrel also showed higher volatility than the S&P 500. Risk-adjusted returns, as measured by the Sharpe and Sortino ratios, were far worse for Cracker Barrel. Clearly, investors were better off owning the S&P 500 instead of Cracker Barrel. Cracker Barrel was founded in 1969 as a restaurant and gift store concept that would appeal to travelers along the interstate. Known for its traditional Southern-style comfort food, the company has over 75,000 employees and is headquartered in Tennessee. Based on my proprietary scoring system, I give Cracker Barrel a 0 out of 10. Cracker Barrel has had glaring issues long before changing the logo. Before I share my final thoughts on that, hit that like button to let YouTube know you love the content. It really helps the channel. And if you want more deep dives into food, beverage, and restaurant stocks, subscribe and ring the notification bell so you don't miss the next video. Your support means the world to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. So my final thoughts on Cracker Barrel. Let's write it out in the spreadsheet. It is a restaurant company with a gross margin of 33%. The 5-year revenue per share CAGR is 8%, and the 5-year free cash flow per share CAGR is minus 44%. Though the margin and revenue growth are good, the free cash flow burn had long been destroying the company. A return on invested capital of 4% is low and worsening. Next, the cash conversion cycle of 19 days is high and worsening. A net debt to EBITDA of 12.9 means that it would take Cracker Barrel nearly 13 years of earnings to pay down their debt. That is ridiculous. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 6.4, indicating that Cracker Barrel is way overvalued relative to its expected earnings growth. Contrary to the sudden groupthink outrage, Cracker Barrel has had growing debt and decreasing earnings for a while now. To recap the events that led up to the hyper-emotional response, Cracker Barrel announced new innovations to their logo and menu on Tuesday, August 19, 2025. The logo rebrand, the company's fifth, updated the logo from a pinto bean to a barrel while maintaining the signature yellow color. The company also revealed a new seasonal menu featuring tasty, if not heart attack-inducing, food. Then 2 days later, the share price sold off over 7%, bottoming at $50.27 and closing at $54.80, representing almost $100 million as lost market capitalization. Many opinions were shared online, and the market absorbed the news and moved on as it does. Shrewd investors will note that there was no incremental drop in revenue with the newly announced innovations, and that the panic selling was a great opportunity for patient investors. Still, Cracker Barrel isn't my cup of tea and has many problems outside of panic selling spectators. What do you think about Cracker Barrel? Share your thoughts in the comments below. I always love hearing from you. Check out some more videos right now, and remember to put your money where your mouth is.